The RBA's dilemma, navigating interest rates and inflation. Say farewell to lower interest rates, as the RBA's decision to hold off on cuts is no surprise. Inflation data can be a dream crusher, and the September quarter CPI figures proved it. Just when hopes were high for an interest rate cut by the Reserve Bank of Australia, RBA, on Melbourne Cup Day, the data dashed those dreams. The 1.2% quarterly inflation growth caught economists and investors off guard, doubling their expectations. But let's be real, the RBA has been seeking reasons to avoid cutting rates. On Monday night, RBA Governor Michele Bullock addressed the Australian business economists. She downplayed the unemployment rate rise to 4.5%, calling it volatile and still low compared to pre-COVID levels. But is that a fair comparison? In 2019, recession fears loomed large. But here's the twist. The RBA now has a convenient reason to overlook rising unemployment. Inflation surged to 3.2% in the past year, up from 2.1% in the year to June. This jump ranks among the top 4 in the last 4 decades. So, what's the deal? Where's the inflation we expected within the RBA's 2% to 3% target band? Interestingly, the trimmed mean, favored by the RBA and rate cut advocates, sits at 2.95%. The weighted median, another inflation measure, is 2.85%. Both remain within the target band, so no need to panic. The CPI spike is attributed to its inclusion of significant price fluctuations, unlike the trimmed mean. This quarter's story revolves around skyrocketing electricity prices due to the end of state subsidies. Electricity prices contributed to approximately 15% of the total inflation increase, despite accounting for only 1.8% of our average spending. Property rates, charges, and new dwelling purchases also played a role. The impact of state electricity rebates is evident when comparing electricity prices in Perth and Brisbane. Brisbane's electricity prices in the September quarter soared 1,694% higher than a year ago, when the rebate was in full effect. This surge isn't due to actual price increases but rather the removal of subsidies. The rebate's influence has mostly faded, except for the federal rebate. This is precisely their intended purpose, to curb high inflation and ease off when inflation subsides. Most prices didn't experience significant jumps, and the inflation increase was primarily driven by a small number of items that rose over 5% in the past year. Meanwhile, the number of items with falling prices remained unchanged. Here's where it gets controversial. The inflation is fueled by electricity, property rates, and rents, causing non-discretionary items to outpace luxury goods in price increases. Discretionary items costs rose by a mere 2.4% on average in the past year, indicating that low-income households bear the brunt of the impact. Additionally, the absence of interest rate cuts will disproportionately affect households with mortgages taken out when rates were higher or those who have already paid off their loans. Remember, both inflation and the proposed remedy of higher interest rates can disproportionately affect younger and less affluent households. So, what's your take? Do you agree that the RBA's decision to maintain interest rates is justified, or do you think they should have cut rates? Share your thoughts in the comment.